Hello everyone, Jeff Chang here. We're going to finish this up, private company valuation, the last section in equity investments. I know you're excited. Here we go. So, private versus public companies. So, there's some company-specific factors. So, the first thing is the stage of its life cycle. So, in most cases, private companies could either be in their typically in their earlier stages of their life cycle, but there are situations where they may also be at the very end of their life cycle, meaning they may have been a public company once and now have gone private and may be closer to the maturing stage of their life cycle. Next one being the size of the company. As a private company, and if they were smaller, they may not have access. They don't have access to the public equity markets, and so there's this kind of cost-benefit relationship associated with should they go public or not go public, given the costs associated and burdens associated with going public. Next, being quality and depth of management. Being a private company and potentially smaller, they may not have access to the higher levels or higher quality managers. This may be a particular issue. And most of these smaller private companies may have management shareholder overlap, where the majority of the shares are owned by the original owners, and which happen to also be management. And so there is, positives and negatives associated with this. In some cases, management may have much more of a long-term perspective because shareholders typically want to see earnings growth quarterly, quarterly within a year. And short-term investors, like I said, publics are more short-term. They're looking for those quarterly earnings. And the quality of information of private companies, information may not be as readily available, may not be as, most of the time they may not be, you may not have financials that are fully audited. In some cases they may just be subject to review, which would only be providing negative assurance. So other things such as taxes may become an issue. When we're looking at taxes, this may be an issue for private companies because of, let's say, private equity firms that may be more concerned about their carried interest. So stock-specific factors when we compare private versus public companies, first one is liquidity. So for private companies, obviously they're going to be less liquid, and the question then becomes is what discount rate do I use to kind of reflect this differential in liquidity? We'll see that in a little bit on different ways to look at that. And the key here with private companies, they're a lot of times may have restrictions on liquidity. There may be restricted stock units that actually can't be sold because, let's say, the initial investor didn't wants management to kind of stick around and they can't actually sell those particular shares. And elaborating on that, we may have also issue of concentration of control where majority of the shares are owned by management themselves, which the actual decision makers may benefit the majority as opposed to minority, meaning management is discretionarily spending, let's say, buying their own jet per se. So these are all factors as far as taking a look at specific factors when you're comparing private versus public companies. So when looking at private firms, you also notice that there's more heterogeneous nature to them in the sense that they're different. They have a variety of different types of risks. And therefore, that leads to a variety of different valuation methods and discount rates that you would use to discount them. You can't just use one just because it's particular, since it's private, because they're all can be very, very different and may have firm-specific or unsystematic risk to it. So what are some of the reasons for valuing private companies? So these reasons kind of are grouped into three main areas. The first one being transactions, so venture capital financing. So when a venture capital firm wants to invest in, let's say, a startup, they'd have to value that private company. Typically when they're looking at that, they're looking at the growth opportunities of that particular firm. When, let's say, an investment bank is looking to IPO a firm, what is the value, what is the price that you're really going to set that IPO at? A firm sale, let's say an acquisition target, what is the value of that particular firm? Well, we could also be looking at bankruptcy, where we're trying to determine, hey, liquidation value, or are they reorging, right? Determining whether or not in bankruptcy you're going to liquidate or reorg. And also the last one being stock-based compensation. What is the value of the company so I can determine the value of the shares, so I can also determine the value of the income to the person receiving the compensation. And the second major reason for valuing private companies can also be compliance, this being financial reporting. In some cases, a company can own another private company. In this case, we need to value the firm to determine, let's say, goodwill or goodwill impairment. Or we're looking at taxes. For tax purposes, what we're looking at is potentially estate, gift, or property tax valuations. This may would cause us to have to value that particular private company. And the third major reason for valuing private companies could be for litigation, from shareholder lawsuits. What are some of the damage claims, lost profits, or even in some cases, let's say, divorce. So the three main areas we're looking at are transactions, which are typically done by bankers or VCs. You have compliance, which are going to mostly done by accountants and tax professionals. And then you have litigation, which will probably be more done by lawyers that are more familiar with like the jurisdiction and precedent of the particular issue that they're looking at. So what are some of the definitions of value? So fair market value. Fair market value, and fair market value is what they define as having certain criteria that you have a willing and able buyer and seller. And it's an arm's length transaction. And you have a well-informed buyer, meaning they understand what they're purchasing. And this basically, because imagine if the buyer had no idea what they're buying and they overpaid twice the value, that we wouldn't call that the fair market value. So think about it. You have a willing and able buyer-seller. It's an arm's length transaction. I'm not selling my car to my parents for $1 million. And then suddenly say my car is worth $1 million, and it's a well-informed buyer that basically is paying a fair price for it because they know what they're kind of getting into. Now, for the purposes of financial reporting, they're really looking at these two, right? It's an arm's length transaction, and it's a well-informed buyer, right? Because here, they not necessarily have to have a willing and able buyer. We're looking to do what? Is just to value the asset. It may not have a particular market just yet, but as long as there's an arm's length transaction that occurred and there's a well-informed buyer. Fair value litigation, we're looking at basically the jurisdiction, precedent, and statutes. This is what fair value for litigation is based off. This is very much of a legal issue. Market value, this is mostly, when we're looking at this, is for real estate, right? And the big one here is that they also have they also have the same kind of criteria here for essentially real estate, but they also have an additional one that the asset is actually marketed. And then the next one being investment value. Investment value is basically for a particular buyer. This is what makes this one different. It's in the terms for a particular buyer, meaning each buyer may have a different value, and this may be from a buyer or company standpoint, because the thing here is what we're focused on here are future cash flows, right? What's the risk? What's the discount rate? Right? What is the financial costs? And are there any synergies with the buyer? Right? So notice this is in terms from a particular buyer or company, and these require what we're looking at as far as from definitions of value. And then you have intrinsic value is basically the value done through investment analysis. Right? You do some investment analysis, you find the intrinsic value, but guess what? This may not be the value that you see out there in the market. It's essentially the value that once other people figure it out, the value of the particular asset or private company approaches that value. So it is not what's reflected out in the market, but eventually through your investment analysis, you're saying it's worth X. Well, out in the market it's worth something different. It is the value eventually that when everybody else realizes, we'll approach that particular value. So approaches to valuation. First one we have income, which is the present value of future income. Market, which is looking at price multiples of comparables, or are we looking at asset-based approaches to valuation, which is essentially looking at assets minus liabilities. Now, keep in mind, what does it say down here? Life cycle should be considered. So just get a general idea. Your income, present value, future income, typically is more common in high growth companies, right? With high growth, I'm going to present value those future cash flows back or future income. Price multiples are typically for more mature companies and focusing on sales. And then assets assets minus liabilities may be for more early stage companies or companies looking in liquidation. So when you're valuing a private company, the proper definition for earnings should be normalized earnings. So you're going to have to do some adjustments to get to a normalized earnings number. So the first one we're looking at, you want to adjust for any non-reoccurring and unusual items because you're looking for that reoccurring earnings to obtain a normalized earnings number. And a lot of times private companies, the management is also the owners, and they're the largest shareholder, so there's going to be perhaps some discretionary expenses. Let's say they bought a jet. And then you also have non-market compensation levels potentially. In some cases, the owners may overpay themselves, and even in early stage companies, they may actually underpay themselves or not pay themselves at all or under market rates. Because what we're looking at here is we're trying to value the company. If the company is actually acquired by a larger firm, then we'll start to pay them market rates. A lot of these discretionary expenses would also kind of not be there anymore. And then additional things, you also have the same issue with personal expenses, potentially from management because they're the largest owner. If you're looking at real estate expenses, you probably want to treat these separately because real estate has different risk characteristics to the actual firm. And in fact, real estate in most cases is depreciable, and so it's going to be at the historical cost. And these would all have to be adjusted when it's actually, if the firm were to be acquired. Any non-market lease rates that they have, if they're paying more or less, you got to adjust those as if, you know, if the company is actually acquired to the market rate. And any strategic versus non-strategic buyers, so adjusting for any synergies that may happen in acquisition to get to a normalized earnings. And also looking at some of the issues in cash flow estimation, you first are going to compare like controlling versus non-controlling interest. We talked about in some previous classes how this is actually worth differently or has different values. So you're going to have to account for whether the cash flows are from a control or non-control perspective. Now, it's also important to run some scenario analysis, whether what's the probability of a sale, what's the probability of an IPO, what's the probability of, let's say, a bankruptcy. And then through this probability, you assign those probabilities and then use the appropriate discount rate for each of the scenarios. And so the third thing, you're looking at the life cycle stage as far as how certain the cash flows are. Are they, what is the uncertainty of those cash flows? And then management biases, because a lot of times analysts, when they're looking at private companies, you're depending on a lot of consultation with management regarding that information. So you got to account for the certainty of, let's say, some of those numbers, some of the cash flows associated with that. And also keep in mind you may want to, let's say, increase the discount rate given the lack of experience potentially for the particular analyst looking at private company firms. And then other things like we covered in free cash flow to the firm, free cash flow to equity, capital structure changes. Remember, we talked about if the capital structure is unstable, we would prefer something like free cash flow to the firm. So in the previous slide, we talked about three main methods of valuation. The first one being this income approach. Then we had the market approach, Then we had the asset-based approach. So we're going to now further kind of dive in the income approach. So first one being there's the free cash flow method. You can use a capitalized cash flow method. This is going to be similar to using a cap rate, as we've seen, very similar to like your Gordon growth model. Or we can do excess earnings. This will be pretty common if the company has significant intangibles. This is going to be like very kind of similar to the concept of residual income, and we'll see these in detail in later slides here. So the first one we're going to cover is free cash flow method. The first thing is you're going to present value the discrete cash flows plus a terminal value. We've seen this in previous classes. It's going to be very similar there. Your terminal value contains may be calculated through a constant growth model, like we've seen, or a price multiple approach. This is not anything new for us. It's just we're doing it in a private company setting. So there is a chance that you may potentially double count for high growth when you're using this price multiple approach, because depending on, remember, the price multiple approach, what are we doing? We're taking multiples of comparable companies and then multiplying it by, let's say, earnings or sales, and multiplying the company's values to achieve price. Now, if we took the multiple from a company that is in a high growth phase, then what ends up happening is when we multiply it through, we will have picked up that multiple that factors in that high growth. Now, think about this. That means we've double counted, because our own model, we started, let's say we did a 3-stage or 2-stage. What we ended up doing was in that first stage, we discounted using a high growth phase. And then the terminal value, we used a multiple from a company that currently is in a high growth phase. So this is what they're talking about when they say a potential double counting of high growth. So the second method under income approach methods is your capitalization of cash flow methods. This should look very similar. You'll notice it's like variations of similar to the Gordon growth model, and we've seen this for free cash flow of the firm, where we would have weighted average cost of capital as the discount or the cap rate at the bottom, and then we would use cost of equity for the value of the equity down at the bottom. None of this stuff should be extremely new. It basically we saw in the previous classes when we covered free cash flow of the firm, free cash flow to equity. So now we're on the third approach under the income approaches, which is the excess earnings method. We just did the capitalized cash flow approach, and then before that, the free cash flow approach. So under the excess earnings method, like I said, it's going to be kind of similar to the residual income method. We're really targeting here, like I said, are companies with some intangible assets. We're going to make the assumption that that additional residual income represents the intangibles. So once I find that residual income over basically its working capital and assets, then I'm going to just value it using a capitalization method. So let's take a look. So in this example, we have essentially total actual identifiable assets of the working capital of $500,000 and fixed assets of $2 million. Notice the fair return or required return on working capital is 5%, and then the required rate of return or fair return on the fixed assets is 10%. So what I'm going to do is I'm going to compare that to what? The normalized earnings. See if there's any excess earnings, and those excess earnings would represent the residual income and thereby help me value the intangibles. Once I have, by the way, the value of these intangibles, I'm going to add them to the actual tangible assets, which are the working capital and fixed assets, to arrive at the value of the firm. So let's take a look. Here we start with looking for the fair return on the working capital, 5% times the 500,000. Then I multiply the fair return, the 10% times the 2 million, or the required return on the fixed assets. That's 200,000. So here is my kind of charge on the working capital and fixed assets minus the normalized earnings to arrive at a residual income of $10,000. Now, what am I going to do with this $10,000? Remember, I'm going to use capitalization, so R minus G. Now, they told me, what was this? If you go look on the previous slide, the return or the discount on your intangibles was what? 20% on the previous slide, and the growth rate on your intangibles was 4%. So we're going to run this through to see what the value, because this represents the value of the intangibles. Let's take a look. So your value of your intangibles, you take the 10,000 times your growth rate to find the residual income of the next period. And then here is my discount rate for the intangible assets. Here's my growth rate for the intangible assets to arrive at $65,000 for the value of the intangibles. Now, I add the tangibles of the working capital fixed assets plus what I just calculated, and then this gets me to the value of firm of $2,565,000. So when we're looking at the discount rate and how to estimate that, when we're looking in the context of private company valuation, let's say we're looking to acquire the private company, there are some elements that we have to take into account on which discount rate to actually use. First one being size premium. That you may increase the discount rate if the company is small. Now, how do you arrive at that premium? You may look at what is the discount rate that you may use for, let's say, publicly traded, small companies. But this may have an upward bias to the discount rate because typically, small public companies are perhaps more commonly in distress. You may look at the availability and cost of debt. This typically has a, for smaller companies and private companies have a higher weighted average cost of capital. This is because in many cases that for private companies, they may not have the access to debt that you would see in a public company. And the other things, do you use, what discount rate do you use, the acquirer versus the target? Potentially when you may use the weighted average cost of capital to acquire, because once you acquire the target, then you opens up more markets to actually raise debt, and perhaps using the lower weighted average cost of capital that the acquirer has, because once you acquire the target, it would have that access. Now, other things, projection risk. Private companies have less information, so I may add additional add to the discount rate because there is less information, right? Other things, life cycle. So life cycle, in some cases you may categorize discounts in these ranges, but it's difficult to classify the stages, and there may be certain things depending on, in the earlier stages there may be firm-specific risk or unsystematic risk, which would have to be taken into account when you look at and estimate the discount rate. Looking at different discount rate models, we have CAPM, which is the capital asset pricing model. Typically, this is not appropriate for private firms that aren't really having a really high chance to IPO or go public in the near future. So what we have is expanded CAPM, where we would add a premium for things such as size and unsystematic risk, which is firm-specific risk, that you would add these premiums to the discount rate. Or you could use a build-up approach, same thing. You start adding premiums for the smaller size of the company, company-specific risk, that unsystematic risk, or risks that are specific to that particular industry. In estimating the weighted average cost of capital in a private firm, let's say for acquisition, you're faced with a decision on whether to use the current capital structure versus the optimal capital structure. So if you're using the current capital structure, it typically is going to be more conservative because in a private company they may not have access to the debt markets, and so and in fact their cost of debt may be higher versus an optimal capital structure where you're using the acquirer's capital structure for which would be optimal because they would have more access to the debt or have lower cost of debt. So in the case of acquisition, you would think that once I acquire the company, I would have a lower weighted average cost of capital once it has access to the debt markets through the actual acquirer. So public versus private firm debt capacity and cost. So in public companies have much more, in most cases have more access, better access to debt, and that thereby leads to a greater weighted average cost of capital for private firms. So we just, in the previous couple of slides, we went over the income approach. Now we're talking about the market approach, which also has three methods. We have the Guideline public company method and the Guideline transaction method and the prior transaction method. So in the guideline public company method, we're going to look at other public companies and then add on premiums. We're going to add on premiums, let's say, for the transaction type, the industry, let's say the industry condition, other considerations, and then check those premiums for reasonableness. And then the next one being the guideline transaction method. Now we're looking at transactions of other companies, right? Other acquisitions. So we're looking at specific transactions and what were the premiums paid on those transactions, and then, you know, controlling for any contingencies, any special considerations, and when the dates of those transactions actually occurred. Meaning, if I had transactions that occurred a year ago, these premiums may have changed. In some cases, that one particular industry may be acquiring a lot, and so the next one, the prior transaction method, now this is different than the first two in the sense that I'm actually looking at transactions for that specific firm that I'm trying to value. And we'll see each of these in detail further. So in the first market approaches, the general public company method, what we have, like I said, we're looking at publicly traded firms, and we're using their multiples. The major advantage here, there's plenty of firms out there, there's plenty of data. The major disadvantage is this data essentially may not be comparable. And so we have to then adjust that data using control premiums. And let's go on to the next slide and check this out. So we're going to look at what was the transaction type. Was it strategic or non-strategic? In the industry conditions, maybe there was a huge amount of acquisitions in that particular industry during that time. What was the type of consideration? Typically, if the consideration given for the acquisition was stock, it may have been overinflated during that time. And reasonableness. So when you start to do and you start to add these control premiums and so on and so forth to it, you're going to start to have these premiums differ wildly. And so you got to check if that premium is essentially reasonable after you have done all of these, adjusted for all of these control premium issues. So under the market approach, the second way is the guideline transaction method. So this is different than what we just saw, the guideline company method, where we went out and looked for public companies that were similar to the specific company we're looking at. In the guideline transaction method, I'm just looking at transactions where companies had acquired other firms. So we're looking at the multiples from actual sales that have occurred, either public or private. Now, some of the issues here is that the private firm data may not be available or accurate in this case. And this data issue, then, what we're looking at under the guideline transaction method is, what was the transaction type? Was it a control acquisition? Was it a non-control acquisition? Were there any contingent considerations? Meaning, do they have to reach certain, let's say, sales goals or so on and so forth, and that's how they basically got that particular valuation? Or what was the type of consideration? Was it cash? Was it stock? And then availability of the data, right? And then also the date of the transaction. If the acquisition had occurred 2 years ago, that's probably really not going to help me valuing my particular firm today. And the third method under the market approaches is the prior transaction method. Now, I'm not looking at just any transaction. Now I'm looking at transactions in the firm or target firm or subject firm that I'm actually looking at. So this is best when I'm valuing the actual minority interest. And I want to make sure that those prior transactions in my subject firm were at arm's length, and that the data is of the same motivation of why I am valuing the particular private firm, and that the data is recent. I don't want a transaction in my specific firm that occurred many, many years ago. Now, we're moving to the asset-based approach. Now, keep in mind, what have we covered so far? We covered the market-based approach, the income-based approach, and now we're doing the asset-based approach. This is the kind of the third main approach here. So with asset-based approach, this is not used for going concerns. In most cases, you're talking about companies that typically may be distressed. Usually the lowest valuation of the three main approaches, right? And the difficulties in the valuation, these are in valuation of individual assets. The assets may be specialized, and there may be significant intangibles. Now, why do we use this? So like I said, usually for distressed firms, troubled firms are target because this is creating the what? The lowest valuation. And finance firms, because securities are typically fairly easy to value. Real estate investment trusts, because we can value that. Real estate investment companies, because they're going to hold liquid assets and marketable securities. Firms with few intangibles, because those are going to be more difficult to value, and natural resource firms where I can actually value the underlying resources inside the firm. So you kind of get a general idea that under this approach is best for when I can actually value the underlying assets within the company. So looking at the discount for lack of control, this kind of spawns from the idea that minority shareholders are at a disadvantage. They can't elect members of the board. They can't select management. And in case they can't determine where investments are made or where payouts are actually made. And so whereas the majority and controlling shareholders, they can put in excessive compensation, so on and so forth. Now, when a private company, let's say, was to go IPO then, this then suddenly becomes much, much more damaging to the minority shareholder. So if you're in a private company without control, or you lack that control, you're going to have to create that discount. Now, some of the issues that same factors that affect control premium affect discount for lack of control. So you'll notice it would then be calculated by control premium. So in this example, we have a control premium of 22%. It's just 1 over 1 plus the control premium, and then 1 minus that value. And notice in this example, we get to 18%. Now, how do we manage this issue? Let's take a look on the next slide here. Using control premiums and discount for lack of control. If you're looking at a comparable data of a controlling interest versus the subject valuation is also a controlling interest, then there is essentially no adjustment that needs to be made. Now, if you're looking at a particular comparable data for controlling interest going to non-controlling interest, then since the transaction that you're going into basically doesn't have control, you're going to need to discount that for the lack of control. Now, if you're going from non-controlling interest to controlling interest, you're going to have to tack on a control premium to adjust the comparable data. Now, if you're in both transactions or non-controlling interest, there's essentially no adjustment needs to be made to the comparable to make the data comparable. Now, looking at the discount for lack of marketability, right? I bought a position in a company, a non-public position. The question then becomes is how much do I discount that position due to its lack of marketability, because potentially I may not be able to sell it. So what we're going to look for is the likelihood that the IPO or firm sale or dividends. In essence, the higher the likelihood of the IPO or firm sale, the lower of the discount for lack of marketability would be. And if it starts to pay dividends, look, you're giving me my cash back. So I'm actually getting a lot of my asset back. So asset duration, essentially earlier payments would bring the discount back, right? Similar to like dividends. Contractual restrictions to be able to sell, right? Any contractual restrictions will actually increase the discount for lack of marketability as the pool of buyers that are able to purchase the position, as that starts to increase, then I can lower the discount for lack of marketability. And then the asset risk, as the assets of the firm, as they are more risky, then I'm obviously going to increase the discount for lack of marketability. So when estimating the degree for lack of marketability, there's a couple ways we can do this. We can look at other companies, their restricted shares versus their publicly traded shares. So I can compare, let's say, their 144A version of their shares, their restricted version, versus where they're publicly traded. And that differential can kind of help me get a determination on and estimating the degree of lack of marketability. Or I can take a look at other companies where compare their pre-IPO prices to their post-IPO prices. The problem here sometimes is that when a company goes IPO, they typically have less risk. Their cash flows are more certain, so it may understate my degree of lack of marketability. A third way would be using put prices. I can value a put. So if I value a put and divide it by the price, basically, and I set the strike at an at-the-money put, and I have the maturity at the date I would estimate that the IPO would actually occur. The benefit of this is I'm actually looking at the put on the target, the specific company I'm actually looking at. But the issue here is that put doesn't really represent actual liquidity there. But I could use their historical volatility or implied volatility to value that put and try to estimate the degree of lack of marketability from that. So challenges with valuation standards. So as there's an increased focus on valuation of private companies, there have been a number of these valuation standards that have come out over the years. And the issue here is there's really no single standard. And compliance is not mandatory. And it's difficult because a lot of times these reports are private, so it's difficult to ensure any compliance. And since it's not mandatory, only the appraiser essentially can ensure that compliance is actually occurring. And there's limited technical guidance associated with these particular standards, and also because they're so different, so heterogeneous. And so the values can differ as these definitions vary across these different types of standards because they are so heterogeneous. All right, lots of stuff here. Keys to the exam. We talked about company-specific and stock-specific factors. Purposes of different types of valuations for private companies. Some major approaches to private company valuation, namely what we talked about, income-based approach, market-based approach, and that asset-based approach. Discount rate models and some of the factors that you have to focus in on. And then we have our guideline public company method, our guideline transaction method, and then our prior transaction method. Make sure you know kind of the differences there. How to calculate and when to use your discount for lack of control and also control premium. And then some of the ways to calculate for discount for lack of marketability. All right, so this is my last section with everyone. I want to wish you good luck on the exam. I hope to see you in one of the final review sessions that we have in several cities. You can look them up on our website. Highly suggest them because, look, there's a lot of material. And when you get through all of the lectures and you're finally, sometime in late April or early May, it really does help to kind of synthesize all of this material. Look, and also, when I took the exam, I was working. I'm sure a lot of you guys out there are too. No one ever feels like they're ahead. And if they do, they have no friends, okay? But the thing is that you want to take as much as, look, you don't want to have to take this exam again. And in fact, what actually CFA stands for is I can't fail another. So you don't want to fail another one of these exams. So the idea is that, look, for me, failure was not an option. So I basically did everything I could to kind of get that on the first try. So I would highly suggest it. It's a great way to kind of synthesize all of the material. And even better, if you can take the time, I think Windsor Week is a great thing, a great program to also attend. Really helps to put all the material together. Candidates from the 8+ years that I've been teaching, everybody has said that it's definitely something valuable. So I really do suggest that is something to kind of put all of this stuff together. Hope to see you at one of these, and good luck on your CFA Level 2 exam.